All right. Today is Tuesday, September 2nd, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. You know, the national anthem of the month of September is the Green Day song, Wake Me Up When September Ends. I disagree. I think September as a month rocks. Not just because it's my birthday month, but it's also because it is the month of the bears when it comes to the stock market. And we just started this month with a big bang that was heard across the globe today. We're talking, of course, about the massive surge that we've seen today in global bond yields. And it's been happening for a while now. But today we've seen a big surge higher specifically in the UK bond market, also known as the gilts. This is a really important topic because a lot of folks talk about the economic black swan. Well, the economic black swan has been around us for years now. Just a matter of, as Warren Buffett always said, when the tide shifts, we begin to find out who's been swimming naked. But what is the ingredient for shifting the tide? The answer is bond yields. And the way they're surging higher across the globe is just going to take a certain number in a certain country, and that's going to be the spark that initiate a global credit crisis. And then people are going to dub it as the black swan, this and that, but it's always been with us. We're just waiting for this ingredient to play out. And the devastation that would come thereafter. We're not just talking about economic recession. We are talking about a global depression. And this is why it's really careful how central banks and governments act at this period of time. Because this is the little window of time that we have left to do something about it. And unfortunately, we're doing the opposite. We're actually exacerbating the problem. I'm going to talk about this in a minute, but when we talk about the setup for the market, this month again began with a bang. The rumors flying over the weekend that the President of the United States has passed. Now, to be honest with you, I thought it was a fugazi piece of news. If the President passed, we'll know about it right away. We lost a lot of civility in this country, but we're not a country that's not going to announce something like this. And the other thing is, an event like this is expected, be it with Trump or if Biden had been president, given the age of these gentlemen. So that could happen at any time, at any moment. And unfortunately, we have this political divide in this country, the blue cult, the red cult, and folks are flying the rumors that the president died because the Republicans did it when Biden was president. We have this stupid back and forth between the two cults, which, by the way, is contributing to the bond market crisis that we see, because political instability is a factor in the uncertainty that investors view the future of these Western countries, and that's why we see less demand for buying their bonds in the long end. We're going to talk about this a little bit more in a minute, but to set up the stage for you how important this week and the week after. Here in the U.S., we have expectations of the Federal Reserve beginning to cut rates as soon as this month, which I think will be a colossal mistake. But Jay Powell, of course, in Jackson Hole, the chairman of the Fed, gave his speech and gave his reason on why he could become open-minded to a rate cut in September. And that is the weakness in the jobs market. But we have warnings now from a lot of economists. The headline reads, Powell's unusual Jackson Hole remarks reveal he's boxed in by Trump's tariffs and deportations, risking a 1970s-style mistake. Meaning, Jay Powell cuts rates, and next thing you know, inflation goes higher. And the problem in the jobs market coming from deportations and AI job replacement, which interest rate cuts are not going to resolve. And that's going to exacerbate the stagflation problem that we have in this economy. Here's another headline for you. Walmart sent a warning to the stock markets and the Fed. Why Jay Powell faces an inflation crisis. Walmart, in a nutshell, saying, look, we can absorb the incurred cost from the tariffs for a little while, but at some point sooner than later, we have to pass it down to the end consumer. Every business will have to do the same, and that's going to increase the risk of inflation. Now, the lunacy is asking the Fed to cut rates under these circumstances and these threats. Of course, we have this Friday a jobs number under the new BLS commissioner, who's supposedly in the pockets of the White House. It'll be interesting to see what number it is that we're going to get, and how would that influence the decision by the Federal Reserve later this month. Not to mention, of course, we're going to get next week a CPI and PPI inflation reports. Those are also going to have an impact on what the Fed is going to do or not do comes the meeting later this month. And if the decision goes contrary to the market expectations right now that the Fed is going to cut rates, we could see massive wave of volatility in this market. I mean, add to it, folks, the uncertainty that we got on Friday, just before the Labor Day holiday. We got a federal appeals court who came out and said that the Trump tariffs are illegal. He doesn't have the authority to have these tariffs. The tariffs should be passed by Congress. It's not an executive branch kind of power. Of course, this is going to go to the Supreme Court. In the meantime, the tariffs are still in play, but it adds to the uncertainty. From one aspect, if you're a business manager, if you're making a decision about inventories, if you're making a decision about pricing policy, what the hell do you do at this point? With all of this fluctuation, all of this conflicting news back and forth, you have huge degree of uncertainty. And you might end up doing the wrong decision. You might decide to increase your inventories right now, increase spending, and next thing you know, the tariffs are deemed illegal. And then what? You're left with oversupply, which is going to crush demand and margins. So this is also impacting the market negatively. The same token, if you happen to be a money manager and your clients are finally up for the year and you see these insane valuations that we see in the stock market, what are you going to do? The rational move is to de-risk, to hedge, to sell some. And that's all adding to the pressure that we're just beginning to see starting in today's session. Don't forget about the September seasonality. That's another factor. All of this is happening, ladies and gentlemen, when we also have, we used to say the golden age of fraud with this bubble, and it's not just AI, it's the crypto bubble, it's the stock market bubble, it's the real estate bubble, lots of speculation, lots of garbage happening. But guess what? The man who shorted Enron and called that fraud, he says, forget about the golden age. We're now at the diamond or the platinum level of fraud. Take, for example, the news that we got today that Anthropic raised $13 billion at a valuation of $183 billion valuation. It's like throwing your money in the toilet. And whoever invested in this round deserved to lose their money. But this is the kind of mania that we're in. A company that's not even proven yet is valued at $183 billion. NVIDIA is valued at almost $4.5 trillion. We see IPOs all over the place with a pump and dump scheme. Look no further than CoreWeave, where we see a huge increase in the share price initially, and then the insiders use that as an opportunity to dump like there is no tomorrow. Scams all over the place, fraud all over the place. The entire economy has become one giant Ponzi scheme. You look at the valuations in the stock market, price to sales ratio, the highest in history. Does that make sense to anybody right now with all the trouble that we have in the real economy? And the stock market concentration is even scarier. You have 6 companies, NVIDIA, Apple, Alphabet, Microsoft, Amazon, and Meta, now forming over 30% of the weight of the S&P 500, meaning that all retirees, all of your 401k right now is dependent on these 6 companies that are severely overvalued right now and dependent on the AI mania bubble to last. Any problem with the AI mania bubble, and we see correction in these names, or worse, perhaps a crash, as the thesis begins to unravel, you could see huge damage in America's 401ks, retirement accounts, investment accounts, and it could be in some cases irreparable. And hence, you as an investor right now, you still got the choice to de-risk. And if you have a responsible money manager, they're going to begin to do that de-risking for you. And of course, on top of all of that, we have CTAs right now maxing out their positioning in the stock market. We know the retail investors are all in. We have euphoria in the stock market. So if there is a sell-off event, the CTAs alone will have to dump over $70 billion. And this is this month alone. So this is the setup, folks, just to give you a picture of what's going on. But what we want to talk about in tonight's program, the topic du jour, what's going on with global bond yields. Because what's happening right now, when you look at the UK, it's the most severe case. In the month of August, yields on the 30-year bond in the UK was up 23 basis points. In the US, up 3 basis points. Germany, 14 basis points. Japan, 12 basis points. All of them are rising. And when you look at the UK, highest level this century means that it costs more and more to borrow for the government, for interest rates in the economy. And why is that happening when the Bank of England, for example, is cutting rates? Why do we see that despite all of this rate cutting initiative by not just the Bank of England, but the ECB and many other banks, yet yields on the long end of the yield curve in the case of the 30 bond yield are moving higher? Let's listen to these 2 Englishmen explaining the situation.
That red line is still the UK. This kind of area is where the rest of the G7, except for Japan, are. And I think the striking thing, Wolf, to look at here is in a period kind of around the pandemic, And actually, for kind of quite a few years before that, look at where the red line is in relation to this area. So that's the highest, the lowest within the rest of the G7 minus Japan. The UK was kind of the middle of the pack. And then suddenly, around the mini budget, it kind of goes up above the rest of the pack. And that's the kind of moment everyone was concerned about. But since then, look at that red line. It's been higher than the rest. And now, I think the worry that people have at the moment is, look, we're a real outlier here. So our interest rates are going up higher than most other countries around the world, even though their lines are going up as well.
I might be preempting a chart that you've got to come, but I think just to add the one extra point to add on this, ours is doing that here on the 30-year chart, which is perhaps the most important for government borrowing, at a time when the Bank of England is moving in the opposite direction on the shorter end. So the sort of one part of the yield curve you can control is coming down, and yet the longer part, the more important part, is rising during that period of time.
You know, you're throwing out my order because I did have a chart on this towards the end. I've got
we
a
should
chart.
have planned this more.
I'll go to it. We're going to roll with it because you're right. Interest rates are coming down, and actually, if you look at kind of the 10-year bond yield, which is kind of also kind of maybe reflecting that shorter end a little bit more, that's coming down as well. Worth saying, though, I think one thing that, this might be a little part of the explanation. It's still a bit of a mystery. Like everyone I spoke to yesterday was like, we're not quite sure why this is happening. But maybe part of it is the fact that back in July, it looked like interest rates in the future, that's the forecast, so the next, or rather what the market thinks is going to happen, they thought it was going to come down kind of that quickly. If you look more recently, so just the last a few days ago, that line is getting higher. So people still expect interest rates to go down. They're just not going down as quickly in the UK as was previously thought.
So right now, the eye of the storm is the UK, but it's happening all over the world. You see it in every G7 country. We see bond yields surging higher. But the situation in the UK is especially severe because you see that the rate in the 30 bond yield is surpassing rates across all of their peers in Europe, in the US, in Japan. And you got to go back to my videos beginning in 23. I've been saying, if there is a global credit event, it will happen from the UK. It's the most fragile economy among the developed nations. We made numerous videos in this channel talking about the UK economy, why it's the most fragile. But let's explain to folks here, why do we see this phenomenon? Because if the central bank is cutting rates, we're supposed to see interest rates going down. Why are they going higher? What's going on here? To begin with, of course, this is basic, but some of you are not aware of this. Why are bond yields surging? We know that we have an inverse relationship between the price of bonds and the yield. The price goes down, yield goes higher. Price goes up, yields go down. Now, what about the chicken or the egg? Which one influences the other? And the short answer is price influences yield. Now, what moves the price of bonds? Easy, demand and supply. If you have less demand, price goes down. If you have more supply, price goes down. And right now we have a combination of both. That's why we see prices going down and yields going higher. Gee, why do we see a problem in demand and supply when it comes to bonds? At least in Western nations, G7 nations. We can boil down the problem to three factors. Number one, rising debt and budget deficits. Number two, shifting global alliances. And number three, future instability. Let's take them one by one. Rising debt and budget deficit. What is the reason behind that? You have defense spending increasing. We know that at least in the NATO alliance, the United States has been doing the majority of the spending. And now we have a president that is requiring all of these nations to begin to increase their spending on defense out of their GDP to 5%. The requirement was 2%. Now we have to go to 5% minimum. If that is the case, more spending requires raising more money and selling more bonds. And hence we see a massive government debt to GDP ratio. In the US, it's about 124 times. In the UK, about 96 times debt versus GDP. In France, which is facing a problem right now, 113% of GDP. In Spain, almost 102%. In Italy, it's 135% of GDP. Germany is a better case, but it's still facing a problem here at 62.5% of GDP. And Germany is, of course, influenced by their alliance in the EU. But we have other factors that also contribute to the increase in debt and budget deficits, including healthcare spending. Western nations have an aging population. they need healthcare spending, so the government has to borrow more to spend on their healthcare. Then we have tax cuts for corporations and the rich, and the example here would be in the U.S., the Big Beautiful Bill, which pretty much increases the deficit by about $5 trillion. And for what? Spending like a drunken sailor in defense and giving tax cuts for the corporations and the rich. We also have preventing a stock market crash, because if the government decides to be responsible and have a fiscal policy that actually reduces the deficit, it ain't going to be pretty good for the stock market. The market actually loves inflation, because inflation means so long as you can pass the inflation cost to the end consumer, your numbers go up as a corporation. Your revenue goes up, your profits go up. So if the government begins to say, nah, we got to take a responsible fiscal policy and we got to cut spending and reduce the deficit, well, that causes recessions. That's not pretty good for the stock market. So to keep the stock market Ponzi scheme going, they have to increase the debt and budget deficits. We also talked about politics. No politician, be it Democrat or Republican, and in European nations, doesn't matter which party it is, no party wants to say, hey folks, we have to address the budget deficit and the national debt. So you know what we're going to do? We're going to raise your taxes and cut spending. That's not going to be a popular policy. You lose elections. Death by democracy, shall we say. Then, of course, we go back to the chicken or the egg, interest payments. It's becoming a massive portion of the deficit and what we pay here in the U.S., in the U.K., in the EU. As we continue to see bond yields going higher, the interest payment on debt also goes higher. So let's go back to the UK situation. And you're going to see really terrifying charts in this segment. Take a look.
Part of it is about inflation. This is showing you the UK's inflation rate, okay? And it's just the rate at which prices are changing each year. And generally speaking, the higher inflation is, the more people think interest rates are going to go up in the future, and so they're going to assume that you're going to have higher borrowing costs going off into the future. And the UK's inflation rate is not just above the Bank of England's 2% target, but look at this. So we're doing the same exercise that we did with those G7 economies when it comes to gilt yields. This is UK versus everyone else when it comes to inflation. And look, we are way out of whack with everyone else. And so if you're looking at that and you're thinking, well, it looks like inflation's a bit kind of, stuck in the UK, maybe you're going to charge a higher interest rate for the UK. So inflation is potentially part of it, but as is what's going on with the public finances. And what's going on with the public finances is, well, this chart tells you a pretty stark story, okay? This is showing you the projections for how much tax revenue is going to come in the UK in the coming years and what's going to happen to spending, okay? And so up until recently, spending, that's the pandemic here, that little spike. Spending has mostly been above taxes, and that's why we have all these deficits. And the bigger the gap between those two lines, the more you're having to borrow. And the more you're having to borrow, the more people want to charge you for that borrowing. This is what's projected in the future. Have a look at that. Look at what happens to the gap between these two. And if you're kind of worried about the Chancellor being able to cut back on spending, then you get very worried about a line like that. And if we kind of break it down, the kinds of things that are responsible for this, we'll take that bar and we'll kind of disaggregate all of the things that are driving higher debt. It's health spending, it's pensioner spending. It's actually some of the things that the Chancellor says she wants to try and bear down on, but we know that she's struggled. So you've had all those U-turns about things like winter fuel. They've struggled to cut back on the difficult stuff, raising the question, what happens to that red line? What happens to that red line, and what does it do as well for the total national debt? Because if you take those two lines I showed you a moment ago, take one away from the other, work out what it means for the total national debt, the total amount that the UK owes, this is what happens. Going off into the 2070s, you are talking about a national debt that is higher than we have ever seen outside of war, 274% of GDP.
So again, you have inflation coming back in the UK, and the expectations are that they're going to see more and more budget deficits in the future, but revenue is not going to increase. So it seems to me that the UK is pretty much on the verge of collapse, and it's going to become sort of a third world country right now that requires rescue by the IMF. And this is why we see specifically a massive problem in the UK bond market, and we see the gilts moving significantly higher. And today, the British pound took a massive hit against the US dollar. Now let's go back to the board. The second reason why we see bond yields surging higher, shifting global alliances. What does that mean? It means there's a part of the world who says, you know what, I don't need you anymore, dear US and European nations, and I don't want to be bullied by you. I'm going to find alternatives in China, in Brazil, in Russia. And part of the reason is the Ukraine war, the Western hegemony, the trade war. And the nationalism, the rise in nationalism all over the place, even in countries like India, China, Russia. And when you have the rise in nationalism, a lot of countries don't want to be bullied by other nations. So let's talk about these factors one by one. In the case of the Ukraine war, you have these European nations spending a lot of money funding this war when they have economic problems at home. And we were doing the same thing under the Biden administration, spending over $300 billion in Ukraine when we had all of these problems that we have at home. And the question becomes, what is the end here? Are we aiming for World War III? Are we aiming for what, really? A peace agreement at some point? Regime change in Russia? What is the goal? And is it really realistic or not? It seems like there is no good answer to that. And there's a lot of lunacy involved. And when you see these European leaders, as we've seen last month when they came to the White House, as the parents of Zelensky of Ukraine, and they sat in front of Donald Trump in the Oval Office like a bunch of school kids facing the headmaster. Isn't that a humiliating look? If you're a citizen of these countries, Germany, France, even Italy. These are big nations. And I'll be upset to see my leader sitting and being humiliated like this. But again, they have no dignity anymore. They will sacrifice all of that just for Ukraine. As a global investor, do you have any respect for these countries to invest in their bond market? Or do you have any faith that there is an end to their ambitions in Ukraine and how that war is going to end? Not to mention, of course, that now we have this pressure by the U.S. and European nations on other nations, be it in South America, be it in Asia, be it all over the world, Middle East, that you have to isolate yourself economically from Russia. And a lot of countries are saying, no, that's not in my national interest. Let's take, for example, the case of India. The Trump administration places 50% tariffs on India as retaliation for Indians buying cheap Russian oil. But the Indians say this is good for our economy, and that's what we care about. And they don't want America or European nations calling the shots and telling them what to do. So here we get the headline. U.S. bond market suffers 61 months drawdown, the longest in history. So foreign investors have taken their money away from the bond market. What does that mean in simple terms? It means that the cost of borrowing has to go higher because we're not having sugar daddies who can fund us anymore and buy our bonds, who can spend on defense and wars and waste and whatnot. To attract the buyers, we need to give them higher rates. And that's why we see bond yields surging higher. Gee, who's been dumping these bonds? We know China has been dumping, but recently we see India joining the U.S. bond dumping party. Headline reads, India reduces exposure to U.S. treasuries while boosting gold holdings in the forex reserves. A lot of central banks are saying, it doesn't make sense to hold U.S. debt or European debt or even the U.S. dollar. The most reliable investment right now is gold. And this is why we see gold hitting all-time highs as we speak right now. The most interesting part of this story is what we've seen over the weekend, the shifting alliance between India, United States, and China. China and India are not the best of friends. If anything, they're enemies. But because of the hostilities that India feels coming from the West against their trade with Russia, India is now pushed all the way to the arms of China, which I think is a massive geopolitical mistake. But I also believe that you have to let the chips fall wherever they may. And right now, over the weekend, we've seen the Shanghai summit. In it, of course, Indian President Modi was talking about how China and India becoming friends and reaffirming commitments and cooperations. And from the videos we've seen over the weekend, the guy looks pretty happy being surrounded by Putin and Xi Jinping. Take a look. And of course, you have the Iranian president. So again, the shifting alliances. But most importantly is what President Xi Jinping said in the summit. Take a look.
New comments from Chinese leader Xi Jinping, who took a veiled dig at the U.S. as he promoted his vision of a new global order. Xi told leaders at a major summit, quote, "The house rules of a few countries should not be imposed by others." He said more as well.
We should advocate for an equal and orderly, multipolar world and a universally beneficial and inclusive economic globalization, and make the global governance system more just and equitable.
So again, we go back to the board. Countries like India, like China, like Brazil, and many more, they don't want to invest in the bond market of the U.S. or the European Union. They'd rather invest in gold and continue to trade and get closer to China and Russia. The third reason why we see bond yields surging higher is future instability. If you have doubt about the future of a certain nation, you're going to demand higher rates to hold their debt. Among the reasons why we see future instability being assumed on these Western nations, including the US, uncontrolled inflation. The problem of inflation is not over yet. It's beginning to heat up again. We got economic inequality, at least here in the US. I mean, we're talking about the first trillionaire. We have guys like Bezos and Musk with a net worth over $300 billion. Meanwhile, the majority of the population is just living month to month and drowning in debt. We see delinquency rates going higher on credit card debt. We see rents being unattainable. We see the American dream of owning a home becoming impossible. Even owning a car now require a long-term loan with higher interest rates. All of that is causing tension in these societies, and it could lead to chaos. If you get a recession, you get higher unemployment, you could see chaos in the streets. We have immigration issues, and that's more evident in European nations where we have a lot of tensions right now. They have uncontrolled immigration, and they brought a lot of folks who are probably not going to contribute to the economy, but be a burden on the economy. That's not a wise idea. So we see that tension, and that could lead again, who knows, civil wars, riots, economic instability. And all of this leads us to the most important point, which is lack of societal cohesion. I've been talking about this terminology for a while now, and you have to keep that in mind. Societal cohesion. That's really important in every nation, that you and your neighbor, regardless of your differences in income or immigration status, whether you're born here or you're not born here, despite the different backgrounds in a certain society, each member feels connected to one another, that they face similar destination, similar future, similar threats, similar hopes and dreams, and belonging. And how could that be possible when you have economic inequality? When the majority of spending in the economy is happening by the top 10% of earners? You see envy, you see anger, you see disgust, you see hatred toward your fellow citizen. We begin to see people blaming each other. You see it all over the world right now, where native citizens blaming the immigrants, and the immigrants blaming the citizen. And it goes into a back and forth when the common enemy for both is the same. I mean, think about the housing situation in America right now. There are a lot of posts online saying, oh, if we increase deportation, that's going to free up the housing market and it's going to be affordable for Americans again. When in reality, the immigrants are not really the ones scooping the homes. It's the BlackRocks, the Blackstones, the Amazons, and the trust fund babies of the world, scooping all of these single-family homes and turning them into rental properties. But they don't want you to point the finger at them. They want this lack of societal cohesion. They want you to blame each other, to be busy fighting each other. Democrat, Republican, black, white, immigrant, unimmigrant. And forget about the common enemy. And on top of that, you have all of these prescription drugs, depression pills all over the country. Everybody's taking them. What do you think that's all about? That's to keep you numb, to keep you zombified about what's really going on in the economy. It's sort of a mass lobotomy of the population. You don't get to think or question the economic problems that we have, the rigged system, the inequality, the irresponsible fiscal policies, the manipulation of markets and assets by the Fed and others. You don't get to question all of that, because all what you got to think about is going to my job, getting an income, putting food on the table, and then enjoy some entertainment in my free time, and then maybe blame all of the problems that I feel on others in the society. Anyhow, another point for future instability is AI unemployment. We're beginning to see that, where new grads are facing a hard time finding a job because nobody wants to hire them, as AI begins to take their entry-level jobs. And little by little, AI begins to take more and more jobs. What is that going to cause? When you have mass unemployment in the economy because of AI, are you going to leave everybody to be poor and go down the streets and do riots and go crazy? Or would you have to borrow even more money and give them universal income? Well, that means raising more debt, exacerbating the problem. And at the same time, if that's the case, at some point, government have to face the reality and do some austerity measures. And that's mainly going to be by increasing taxes. If that is the case, you lower the growth. And if I want to borrow your debt right now, I'm going to ask for a higher interest rates looking at all of this future. So I hope that the issue right now is clarified on why we see this phenomenon. Okay, what is the remedy? How can we rescue the situation right now before it's too late? I tweeted this today. What's happening in the UK bond market is proof that central banks lost control over interest rates. The only way to bring these rates down is if the BOE and other central banks actually begin hiking rates and allow the shadow recession to come to the surface. What do we mean by that? Because cutting rates by central banks actually led to bond yields going higher, not lower. So doing the same, expecting different results, is the definition of insanity. It seems that we are insane. We're asking the Federal Reserve to do the same thing, the same mistake that the Bank of England and the ECB done, when in reality we should be asking for the Federal Reserve and all of these central banks to face the reality. Raise interest rates, crash the bubble in assets, in the stock market, in cryptos, and real estate, and reset the economy. And sure, there's going to be pain, unemployment, etc. But you're achieving two things if you pop the bubble right now by hiking rates higher. First of all, inflation doesn't become a problem because you have a recession. And recession is the natural remedy of inflation. And we said that repeatedly in the program. The sooner we accept this fact that when you have inflation going haywire, you gotta induce recession in the economy to fix it. But we have the Federal Reserve thinking that they're God. The soft landing, they said. We don't have to do a recession. We can actually cut rates even more. And inflation would just stay tame because it's been tame for years. And that's the problem that we're facing. The sooner we accept the recession, the minimal the economic consequences. But if you have to play God and aim for soft landing and deny that recession is the natural remedy of inflation, well, guess what's going to happen? You're going to have a stagflation problem, and sooner than later, bond yields will keep going higher, delinquencies in the economy will go higher, inflation will cause a lot of damage and consumption in the economy, and little by little, you're going to have a forced recession, which could be turned into a depression. The severity will be much higher than if we accept it sooner. The second benefit of hiking rates and inducing a recession is you're going to eliminate the interest payment. That's a huge part of what the government is paying right now, not just in the US, but as you've seen in the UK as well. And the added benefit to all of this is hiking rates, forcing a recession in the economy right now will halt the creation of the monster, AI. AI is going to take jobs. Are we going to wait till we see unemployment by AI being exacerbated and then a recession be even more devastating, a nail in the coffin? And we see chaos and instability? Or do we stop the mania right now by forcing a recession and forcing the hands of these maniacs, the leaders of these technology companies, to stop creating the monster and pause for a second and allow regulation, allow debate to happen on how we view AI in our society and what we want it to do. Anyhow, folks, interesting conversation. Please continue this conversation in the comments section. Let me know what you think about it. But right now, I got to segue to the second part of this program, the market information, because we had an interesting session today. We're probably going to have interesting few sessions this week all the way to the next week. So let's talk about it and move on to the market information, beginning with the closing of the indices today. And here we go. All of the indices closed negative today, but far off the worst levels of the session today. So you see your value of rotation in the Dow Jones, that was negative today, but it performed a little better than your risk-on technology rotation in the NASDAQ and the S&P. And even the bets on interest rates going down, being cut in September, evident by the Russell 2000, were diminished a little bit today. And we've seen the Russell 2000 going negative by about 0.5 percentage point. Looking at the sectors, all negative for the most part. Two sectors managed to close positive. They happen to be defensive. They happen to be resilient to the increase in bond yields. That is healthcare and energy. We'll talk about why in a minute when we do the heat map analysis. Looking at the breadth of the market today, the dealer, aka the market maker, lost. Because if they win, they close it at 50-50. But today they lost, and they lost to the bears. They've seen a lot of puts that are threatening to be in the money, so they had to dump more and more shares, and in some cases they had to eat a loss. So in the NYSE, we see 27% of the volume advancing versus 71% declining. In the NASDAQ, 34% advancing versus 64% declining. Looking at the heat map, majority of the sell-off happened in the technology names, the AI mania, the cyclical side of the economy. Think about shipping companies, think about airliners, think about cruises and hotels. All of these names were down. The banks were down. What was bought, though? It was some of the defensive names. So you have healthcare, the big pharmaceuticals. I would not trust biotechnology. I think biotechnology has a lot of M&A speculation. That's why it performed positive. But the nature of defense today was unique because bond yields were going higher. And when bond yields go higher, you have traditional defensive sectors, dividend-paying sectors like staples underperforming, real estate underperforming, utilities underperforming. All of these are defensive sectors, but they compete with bond yields. If you have bond yields paying you more than the dividend that these companies pay, then why would you want to take the risk if you can just stick with the bond? In the case of healthcare, it's more resilient to that because the investment thesis is not just about the dividend alone. It's about an aging population, about healthcare spending and necessities. So we see healthcare performing better. You see the gold miners, the shift toward the safety of gold, and energy also performs pretty good when we see bond yields surging higher. On top of that, of course, there's a theme that we've been talking about in this channel since the beginning. It's actually, we began adding these names in the Maverick portfolio in the third quarter of last year. We're talking about the Chinese names like Alibaba, Pinduoduo, JD, all of them were up for the day. So again, the heat map today is saying that we have maybe seasonality, a little bit of de-risking going on. So folks are taking profits from the stuff that went higher, and they're rotating toward companies that could withstand a little bit better in healthcare, in gold miners, some of the defensives, but also in cash. And that means that if the fear recedes, we could see a redeployment of that cash back into risk on. My hunch, though, given the seasonality, given the action that we see in bond yields, and the uncertainty about the prospects of the Fed cutting rates later this month, coming from a highly anticipated jobs number this Friday and then CPI and PPI reports next week, I would say that the defensive rotation shall continue. Moving on to commodities. The scariest setup that you can see is the dollar going higher. Of course, you see the British pound and the Japanese yen going down by about 1% apiece. That's contributing to the dollar going higher. Now, usually, when the dollar goes higher, this is not pretty good for metals like gold, silver, copper, palladium. Yet when we see metals and the dollar heading higher together, it's a huge warning sign because it shows an ultra defensive move, that something is going on in global markets, and this is why we see a rush to the US dollar, but most importantly, to the metals at the same time. So we see gold, silver, platinum, copper, palladium, all of them up big today and outperforming the dollar. Really interesting, and again, it's been a theme that we talked about since the beginning of the year, the inverse dollar trade, and specifically metals, that you have to be long copper, palladium, platinum, silver, gold, all of them are replacing bond yields and currencies. You see also crude oil going higher. The rumor is now that we've seen India getting closer to Russia and China, the tariffs against India will increase. If that is the case, then we're probably going to see higher oil prices. Geopolitics, of course, is a reason, but also this defensive move when we see bond yields going higher. Usually that's pretty good for crude oil, so we see a pop in the WTI of about 2.5%. About 1.25 in Brent, and the gasoline RBOB, when you see it outperforming the WTI, that's pretty good for the refiners. So we see the gasoline RBOB up about 3.5%, and heating oil, diesel, the cost of transportation in the economy, up about a little over 4.25%. We see pullback across the board in softs, in cocoa, in OJ, in coffee, in lumber, and in grains at the same time. Those are more sensitive to the dollar. Metals have the capacity of defying the dollar if there is a risk event, as we've seen in today's session. But softs and grains, they have a higher degree of reliance on the US dollar. Moving on to the big casino, the options market, what do we see here? The volume is down. We're coming out of a Labor Day holiday, so not all of the traders are back yet. So we see the volume down across the board. We don't see anything that really stands out in terms of volatility, the IV ranks or percentile. So I would say right now, since the VIX is still below 20, we have a lot of uncertainty this month, including seasonality. Why not take the advantage and hedge your portfolio? Buy puts on the names that you got, set stop losses, and the puts right now are cheap, but if the VIX passes 20, they're not going to be cheap anymore. If you see the IV ranks moving higher in this list right here, your cost of hedging will go higher too. Keep that in mind. Now, when we do the gamma study for the end of the week, you have the gamma flip at 647.78. Right now we're trading, or we closed at 640, so we're behind the gamma flip point, meaning that the pressure is going to be to the downside. Unless we do what? Unless we go above the gamma flip. That's going to require some sort of a catalyst. So the expectations are that we're going to see more and more selling here. The selling pressure is going to be dominating. So you have your cold wall at 650, but you got to beat the gamma flip before you even talk about the cold wall. Right now, since we're behind the gamma flip, the possibility of revisiting the put wall at 635 which we kind of did today. But we called that out, by the way, in the live stream today. Before it happened, we said, hey, we're going to have it revisit the 635, and we got it. But we did not break 635. Now, if we go down again 635 and we break that support, then we have to study the open interest. And you see the yellow bar, the highest number here is at 630, which means that if we have an inverse squeeze after we break the put wall, it could lead us all the way to 630. So you need some sort of a piece of news, a piece of an algorithmic trigger to buy the market to avoid this scenario that we're talking about. I think it's kind of harder said than done in a week when you have a jobs number and you have all of this instability. And that leads us to the unusual activities. Check this out. GLD, gold. We see a bullish trade here. A lot of you are saying, hey, is gold breaking out? Is it too overbought? I would say right now the conditions are pretty good for gold to go higher. Now, the only problem that I see with gold is if we have a hotter jobs number on Friday, we could see the prospects of interest rate cuts by the Fed going down, and that's going to firm up the US dollar. If that happens, then gold will probably have to give up. See, gold can defy the dollar going higher if the source of weakness is coming from, a foreign currency, in the case of the British pound today, went down. And that's why the dollar went higher. But if the dollar goes higher because of a fundamental reason here, such as jobs number or inflation, then gold cannot defy that for too long. But right now, the traders think that gold is the place to be, and I think it is breaking out, and it's the best hedge really against everything. It's been outperforming the market, it's been outperforming inflation, everything. In this case, the GLD, the gold ETF, is trading at about $325 a share. The trader here thinks we're going to go above 335 by the expiration date October 17th, so they bought the 335 calls, but to finance that, they sold the 345. Same expiration date. In other words, they think that gold is going to be above 335, but not above 345 by the expiration date of October 17th. And even if it is, they're still going to flip a really nice profit of about 300%. All in all, paying about $1 million. If we look at the flows for GLD today, this was not at the end of the session, by the way. This was a couple of hours before the end of the session. And even then, the net flows were about $7 million. In the bullish side for GLD. So the traders still expecting higher prices to come in gold. Here comes another one, GDX, the gold miners ETF. We have a reverse diagonal put spread. What the hell does that mean? It means that the trader thinks that we're going to go higher in the GDX gold miners. And we're going to go way higher than 59. Right now, we're trading at about 64, meaning they don't think that we're going to see a pullback to 59. That's not going to happen. So they sold the 59 puts. The expiration date is Jan 16, 2026. That way, if the GDX trades above 59 by the expiration date, they collect the entirety of the premium. If GDX trades below 59, they think that it's a good price to buy. If these puts are exercised, their obligation, when you sell puts, your obligation is, let's say GDX closes at 58 by the expiration date. Obligation is to buy GDX at 59. They think that's a good price, but they also have a stop loss in case it goes the other way. And this stop loss is what they bought here, the 52 puts for the expiration date of December 19, 2025. All in all, they've collected a premium of about $7.5 million. It is a brilliant strategy. We have another bullish one for you here for the ticker VLY, Valley National Bank Corp. It looks to me that this is somebody who's buying a position in this stock via call options. The name right now is trading at about $10. They bought the 11 calls for the expiration date of Jan 16, 2026, spending about a little over $1.25 million. What about the bearish trades? We have the IWM. They're buying the 221 and the 223 puts, the 222. Across the board here for different expiration dates, September 19th and October 17th, spending millions and millions of dollars. How would the IWM small caps go down? If we see a hotter jobs number, hotter inflation report, the prospects of a rate cut in September goes poof, gone. Then the IWM is going to reverse a lot of the gains that are produced recently. IWM likes interest rate cuts, dislikes interest rates not being cut, staying as high as they are right now. And the last bearish one I got for you is this one against the SPY, the S&P 500. Right now, we're trading about 640. The trader thinks we're going to go way below. We're going to break 600 as support. So they bought the 609 and the 605 puts for the expiration date of October 17th, spending about $7.5 million. Interesting. So they're betting that the SPY would lose about 7 to 8% of its value comes October 17th. We'll see. Let's do some charts, and we begin with the E-mini futures 2 hours chart for the S&P 500. What can we see here? I got my S1 support 1 already broken. Then we got support number 2 about 6,390. So long as we're trading above, the bulls still got the advantage. You close below, they no longer have the advantage. And then we have this gray zone right here all the way to 6,240. If we break that number, that's going to be S3, support number 3. Then the bears begin to dominate once again. We see some threatening signs. For example, you have a topping head and shoulder going on right here. Maybe you have a neckline that's already broken, and now we're just testing this double bottom right here. See if we're going to break it, and if we do break it indeed, then we have probably a flush all the way to the bear at 6,240, 250, give or take. Now, if we clean this up and see what TradingView thinks about it, it gives you the automatic chart patterns. What they think here is we have a double top and a rising wedge pattern, and the breakdown, it's going to happen in time, not in tomorrow's session, maybe if we have an inverse gamma, but the target from this pattern right here would be all the way down. They see it at about 6,200. Now, I have a promotion for you. If you go to the link in the descriptions that I have in this video, you'll find a link for TradingView. If you want to subscribe to this platform right here, it gives you about $15 off. And if you have the premium tier, you can have the automatic chart patterns. Not always accurate, but they help you out once in a while to see things different. You can probably see it clearer here in the SPY. If you look at the SPY daily chart, they have a rising wedge. They think that the target would be around 600. That's going to be in or around the 200 days moving average in orange right here. So it's really interesting. If we do it, I think we'll do it fast. And I think that the catalyst will be the fact that we're not going to get interest rate cuts in September because of a hotter jobs data or a hotter inflation data. And in that case, if we have a hotter inflation data, what do you think is going to happen to bond yields? The problem will be exacerbated. We're going to see 5% plus in the 30-year bond yield, and that could lead to a flush in the S&P. I'm not going to bet on it right now. I need to see a little bit more before I do that bet, but this is the pattern that at least TradingView sees right now. And it makes sense because the 200 has been support before. You can see it right around here. It's been resistance before. You can see it right around here. What about the NASDAQ futures? I see what could be a topping head and shoulder right now. TradingView probably sees different things. They see a rising wedge with this target, then they see a falling wedge within the rising. So they give you all the patterns and the targets. And this is one of the problems that we have with the automatic patterns, that you have to look at them and comb, and sometimes it's not going to give you the view, so you have to do it manually here. And what I see, in my opinion, is a topping in a shoulder, not a rising wedge or a falling wedge. And I see the neckline in or around the 50 days moving average. If we break that, I think we hit down to 23,000. And if we break 23,000, then we're probably going to find some support in or around this zone right here. Give or take 22,000 should be a pretty good support. So if we lose the 50 in tomorrow's session, meaning closing below, I'm probably going to initiate a put debit spread. I'm going to buy the 23,000 and then sell the 22, and it's probably going to go all the way to October's expiration. The Russell 2000, we talked about the bull flag, aka the ABC pattern. Okay, that broke out and played out. Now what? It is dependent on the prospects of interest rate cuts. The Russell 2000 really sensitive to that. And again, hotter jobs data, hotter inflation means that the IWM Russell 2000 we're probably going to give up a lot of these gains. If we see what they think about it here in the auto patterns, again, they concur that we have an inverse in the shoulder that played out, but right now we have a rising wedge. And the target they give us is about, let's see here, 2,150. That could coincide with the 200 days moving average in orange. Possibility, but I think it's going to be dependent more on whether the data merits or cancels the interest rate cut expectations for September. The dollar index, the Dixie, it is breaking off this declining or sloping line of resistance, so it is moving higher, and I think that the expectations right now, we have a problem overseas, so we see a rush to the dollar from the Great British Pound and the euro, and perhaps the Japanese yen. At the same time, we have expectations here in the U.S. What if the jobs number come out hot? What if the inflation data come out hot? Then the expectations for interest rate cut in September will go down, and the dollar is going to firm up based on that assumption. So again, my advice for you, if you have exposure in the metals, copper, aluminum, even some of the commodities like coal and lithium, you want to hedge those, because if the jobs number of Friday comes out hot, the dollar could go all the way to 99 plus. If that is the case, you're going to see sharp declines of these names. Take advantage of the VIX being below 20 to hedge these names that are dollar sensitive in your portfolio. I know the gold miners, for example, did pretty good today, but if you have a pop in the dollar based on a hotter jobs number, not a declining foreign currency as we've seen today, then even gold and gold miners, silver will begin to decline too. Speaking of, right now, the old man gold is breaking out. So this is pretty good because you have sort of a box here of a trading zone consolidation, and now you're releasing that energy to the upside. So right now, the outlook is bullish for gold, but I think the only way that's going to stop is if we see the dollar surging higher based on an event that would cancel the interest rate cuts. That could be a jobs number, that could be a CPI number. The most important chart right now, the 30-year bond yield. It dictates the interest rate that you pay in your mortgage, your auto loan, your credit card. So right now we have somewhat of a double bottom right here, sloping line of resistance. You have stop 1, stop 2, 3. Would it work out? Or will third time would be a charm? We have a break above 5% and a surge higher, and if that is the case, or the market is not going to hold. The market will begin to decline rapidly. One of the most sensitive ETFs to the 30-year bond yield is the XHB, the home builders. And right now, looking at the patterns, they see a rising wedge. And if we see the 30-year trading above 5% plus, the mortgage rates will go higher. You're going to still have the problem in the housing market, so the home builders are going to be damaged, and the target would be here in or around 100 in the XHB. What about crude oil? Crude oil, we see a falling wedge pattern. It's above the 50. It's above the 200 days moving average. Again, they give us a target at 78.5. I think that's a little bit far-fetched here. I would aim to 70 for now, that we could see crude oil going to 70. And we gave you some ideas in the energy stocks in the morning brief last week. I gave you some names and the setups, and we'll address that by the end of the week because we have pretty good setups in energy right now. NVIDIA, most important name in the market. What do we see here? Topping in his shoulder. We've broken the neckline around 174, and right now I see a little bit of oversold conditions in the RSI and the hourly. So I would not be surprised to see a rebound a little bit, but it could work out at the end of the day as an inverse ABC pattern like this, and then we go down and visit this reaction right here in or around 165. That's a possibility. And lastly, Bitcoin. What do we see here in Bitcoin? It is below the 50 days moving average. And right now, give it the benefit of the doubt because it's still maybe falling wedge right here and begins to head higher, retest the 50. But boy, if the dollar goes higher, then I think that you got to look at this resistance right here, the top of this candle, about 112,650, give or take. If we don't close above, then I think we go down. And if we go down, then there is no falling wedge. We have probably sort of an inverse ABC, with the target being 104,000. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We got a bunch of Fed zombies from St. Louis and Minneapolis speaking, and then we have the Fed Beige Book. But on the economic front, we have job openings and factory orders. Perhaps more important is the earnings calendar. We have CRM, Salesforce. We have a company like Figma. I like the company, I like the idea behind it, but the valuation is not pretty good, so let's see if the numbers justify the valuation right now or not. We have DLTR, Dollar Tree, which we own in the portfolio, and we gave you a hedging strategy against that. We have Campbell Soup Company, CPB, also a pulse in the consumer. And by the way, I think there was a viewer in Discord who asked me today about Campbell Soup. I might have forgot to answer that question, so if I recall this correctly, please forgive me for that. Now that I'm looking at it, I'm remembering that question. Maybe I did address it, but I don't remember right now. We also have Macy's, another pulse in the consumer. So we have plenty of good names here that will give us an idea of what to expect from the economy. Last thing I want to share with you is, if you happen to be a member in the channel, we're going to have an Options 101 video to cover for you before the bell tomorrow. That's going to cover the Iron Butterfly. We've done a recent Iron Butterfly for CrowdStrike before earnings, and it was a successful one. And we needed a massive amount of credit for free. The market maker is just giving you money. So we're going to discuss the setup for an Iron Butterfly, how to use them, how to utilize them, and how to exploit them. In this upcoming week, we have names like CRM reporting. We have names like Lulu. We have names like Broadcom. We might deploy this strategy, the Iron Butterfly, in some of these names. So stay tuned for that discussion. But for now, this is all I got for you, folks. If you enjoyed the conversation, please help us out by pressing the like button, subscribing to the channel, continue the conversation in the comment section below, and better yet, support us and access the full coverage. All of the videos for the week and the bonus videos by becoming a Maverick member. You're going to find the links in the description of this video and the comment section. You can join us on YouTube or on Patreon, whichever one you like. But with that, folks, that wraps up the coverage tonight. Thank you so much for joining me. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Think of everything we've accomplished, man. Out these windows, we will view the collapse of financial history. One step closer to economic equilibrium.